Hi, everybody, and welcome to our third quarterly investor call of 2022, and thank you for joining us today. We'll be hosting a Q&A session at the end of this call, so please use the question or chat box to submit questions to Justin, Peter, and Dominic throughout the presentation. We will address all questions at the end of the call. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, then clicking on the Quarterly Investor Call. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe Stevens Advisory website located under the Resources tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thank you, Carly. Good afternoon, and thank you for joining us today. This is an important call, and I appreciate you being here to listen to our commentary. We are here to answer questions at the end of the call, so if you think of something you'd like to ask us, please type it into the chat box, and we will answer those questions in the order that they are received. So through the first 6 months of 2022, we've faced challenging times as investors. The stock market, measured by the S&P 500, closed out the second quarter in bear market territory. We also saw the Federal Reserve increase interest rates at the highest level in 40 years to curb the highest inflation we've experienced since the 1980s. The concerns we're hearing include a looming recession, a housing market crash, inflation, and interest rates rising, and possibly further declines in the value of stocks. So my objective on the market and economic update section of today's call is to address each of these issues. I'm going to explain what a bear market is and what a recession is, and I'll let you know what we think about each of those things and how we plan to respond. And then Dominic is going to discuss the positions we've purchased during the previous 3 months. He'll give you some insights into what we see in these businesses today. And those two companies he's going to cover are Donnelly Financial and GreenFirst Forest Products. And then, as Carly said, at the end of the call, we'll field any questions that come in. Again, you can type those questions into the chat box at any time during the call, and we'll address the questions in the order that they're received. So, as I mentioned, we've officially entered bear market territory, and I'm sure many of you have heard of this terminology before. Many of you have lived through previous bear markets. When markets are going up, it's considered a bull market. And when markets are dropping, it's considered a bear market. And the technical threshold for a bear market is when a major index like the Dow or the S&P 500 closes down more than 20% from its highest closing price. So in our current circumstances, this high closing price occurred on January 3rd of this year. And during the recent weeks, we've seen the index drop at its lowest point down 23.6% on June 16th. So for historical context, we've put a slide up on the screen. This line chart shows the bear markets since the Great Depression days. And there are 26 of them depicted in this chart. And for context, a few of the more memorable bear markets are called out with darker lines, and the years are highlighted for these bear markets. And what this chart shows us, if we read it from top to bottom, is how much loss occurred during each of those bear markets as a percentage. The lines that extend further down the page indicate a deeper decline in prices from a percentage standpoint. And if you read it from left to right, you see the lines show us the duration of the bear market based on how many days that bear market lasted. So the longer the bear market lasted, the further to the right on the page the line goes. So if you start on the left side, you can see that the pandemic market of 2020 was a very steep line, meaning all that decline happened over a very short period of time, and then a reversal occurred. That was actually the quickest bear market in history, and it was about average in terms of the overall price decline. But when we look across the chart, we see that it's not uncommon for many bear markets to last for over a year or more. So this chart actually measures trading days, not the full year. And just for context, the average trading days in a year is 252 days. So if we look at that 2007, 2008 black line, the financial crisis bear market days, that bear market lasted just shy of 300 trading days, which is about a year and a half. So the red line in the corresponding text indicates where we stood just before the end of the second quarter. As you can see, the bear market we're in today, it's somewhat mild compared to many others that we've lived through. It's also only been going on for a relatively short period of time compared to history. And of course, we don't know when this is going to end. We don't have a crystal ball to know when things will turn around. But we do have plenty of experience in these types of environments, though. And this historical perspective gives us the backing up of our rationale to keep our wits about us during these periods of market turmoil. And I just want to show you a little bit more about what this means for us and the things that we're considering during this current down market that we're in. So I have another chart up here on the screen. This one shows us the history of S&P 500 performance through the U.S. bull markets, bear markets, and recessions. And there's a lot of information on this screen. It goes all the way back to 1926. But just first notice that there's a definite pattern here. The gray bars notate a recession, and there have been 15 of them since the Great Depression in the mid to late 1920s. The blue shaded parts of the chart notate a bull market. And just notice how much larger of a portion of the long term those bull markets make up. And also, just notice that those bull markets sometimes extend right through the recession or many recessions, meaning that markets can continue to advance despite the economy slowing down. And the yellow shaded portions of the chart make up the bear markets. So that's when the stock market was down more than 20%. And notice how the yellow shading typically covers a shorter amount of time, and the decline is considerably smaller than the blue shaded advances that follow each one. So by no means do we think this time is going to be different. We don't know exactly what the storyline is going to be, when the bear market will end, when stocks will recover, but we do know our history. And here's a couple of interesting points that went along with this chart from First Trust. The average bear market since 1926 lasted 1.3 years with an average cumulative loss of 38%. Compare that to the average bull market since 1926, which lasted 6.6 years with an average cumulative return of 339%. So these are the facts, and from an investor standpoint, the lesson here is to stick it out through these periods of decline, to continue to stay invested for the long term. We don't believe that timing the market is possible, and it's not something we're interested in trying to do. Instead, our efforts in this environment are to continue to add to positions where we maintain high conviction, and we're also keeping a close eye on any positions that might be better replaced with other holdings. And that could be due to overall financial strength and the ability to buy higher quality assets at bargain prices. Now, I want to shift gears a little bit and talk about the difference between a bear market, which is a stock market event, and a recession, which is an economic event. These two things often get lumped together because, as you saw on the last slide, they sometimes coincide with one another, but they're two totally separate things. A recession is an event that occurs when economic growth stops and our economic output shrinks from one quarter to the next one. And the key to what qualifies it as a recession is that shrinkage must occur for 2 consecutive quarters, or half a year. And as you might have guessed it, we've confirmed that the first quarter of 2022 in the United States, economic output shrank by 1.6%. And we actually won't know what happened in quarter 2 until the data is confirmed, which that confirmation comes in late September. But there's a lot of speculation that the Federal Reserve's interest rate hikes that occurred over the recent months will create another quarter of negative growth. So that would technically mean that the U.S. economy is in a recession. So the basis for a recession has nothing to do with the stock market. It has to do with the economic indicators like our trade balance, manufacturing output, and consumer spending. And those are the items that drive our gross domestic product, which is how we measure our nation's economic output. The link, though, between the stock market and our economy has everything to do with investors' expectations versus reality. So I'm going to borrow a quote from the grandfather of value investing to help me explain what this means for us as investors. Benjamin Graham, who we've referenced on these calls before, explained the markets like this. In the short run, the market is like a voting machine, but in the long run, it is a weighing machine. And today, the votes are in. Investors are buckling down for some challenging times, and we have confirmation of this based on the amount of money that's left stocks during the first 6 months of the year. And most people are not hardwired to behave well as investors. They panic during periods of uncertainty. They tend to overreact to protect themselves from the worst case scenarios. But if we go back to that idea of expectations versus reality comment that I made, the market can perform well despite a shrinking economy or underwhelming performances from businesses, provided that those outcomes were less bad than investors expected. Let me say that another way just to make it more clear. If things do get worse, but they're not as bad as everyone thought they would be, stocks can still go up. On the other hand, stocks will go down if the real outcomes were worse than investors' expectations. And human nature in investing, it's just a back and forth exaggeration of expectations versus reality. So where things stand today, it's pretty clear to us that most investors are expecting negative outcomes in the coming months. And I think it's important to acknowledge that we think they're mostly right about some of those things. Interest rates are going to increase. Economic growth might be negative for another quarter or more. And the U.S. economy could enter a recession. Corporate earnings could shrink, and we could see unemployment figures start to rise again. But that's a big but. We don't think it's going to be as bad as investors are preparing for. So here's why we think that. The first area of resilience that we see in our economy is in the labor market. At the end of May, actually this chart goes back to May 2007. I know that writing's a little small there. So if we look on the right side of this chart, shows the May 2022 numbers. And at the end of May, there were about 2 job openings available for every 1 person who was unemployed and looking for a job. Across the country, companies are trying to find people to work, and our unemployment rate is near historic lows. For the individual, this means wages are increasing. And on a macroeconomic level, this situation provides us as an economy with an additional buffer should things start to slow down. Before the unemployment rate starts to increase, though, this big gap needs to be filled. And this is a perfect example of a situation where it could get worse, but it likely won't be as bad as investors are thinking. Now, in addition to unemployment numbers being a bright point, corporate cash is also nearing the highest levels we've seen in decades. The current cash balance across the S&P 500 companies was over $2 trillion. Corporations they've been hoarding cash during this growing period of uncertainty in a rising interest rate environment. And those corporate balance sheets are strong right now, which means most companies also have the ability to access the credit markets if things get worse. So as economic uncertainty starts to clear up, this actually should provide another buoy for stock investors, because those corporations with this excess cash will start to distribute cash to shareholders, whether that comes to us in dividends or in stock buybacks. Both of those things are good and will eventually lead us back to rising stock prices. The final point I'll look at here that I think is a bright point is the housing market. And there are concerns that keep coming up in our meetings. Specifically, the question is, are we going to see a housing market crash like we saw in 2009? And in our opinion, this is a misguided concern. Yes, home prices rose dramatically in 2006 and 2007. That led up to that big market crash in 2008 and into 2009. And in the last 2 years, we've seen the average home prices in the United States go up by 33%, which is huge. But the main difference today is that supply shortage is what's driving the prices up. Going into the Great Recession of 2008 and 2009, it was unlimited access to financing and lousy mortgage underwriting that drove home prices up. And that in turn led to a massive amount of overbuilding. And when the music stopped in the lending arena, prices plummeted. The events that led up to that Great Recession were entirely different than what we see today. In fact, we've had the opposite problem in the United States. We have a huge housing shortage, and the biggest area of shortfall is in the entry-level home space. And so when we look at the demographics, when we couple that housing shortage with increasing demand from the 72 million millennials who are relatively new to the home buying market, we have this perfect storm for rising home prices, and we don't see that slowing down for at least another decade. So given those circumstances, it's hard to imagine a collapse in prices when there's so much pent-up demand and such a low supply. Yes, price increases are probably going to slow down as interest rates go up, and we might see the prices at the highest end of the home buying market drop more significantly if rates rise further. And no, this is not a good thing. It doesn't make it easier for millennials to buy homes, but it does provide us as a nation with an important protection of the value of the largest asset that most Americans own, which is their home. So we don't think home prices are going to drop. The growth rates that we've seen recently should probably slow down with rising rates. The 30-year mortgage will likely remain more in line with its longer-term average, and it's going to make it more difficult for new home buyers to enter the market. From an investment standpoint, we see some tailwinds for real estate businesses that we own in our portfolio and in the suppliers to the home building market that we own. The bottom line here is that there are some clouds and some bright spots in the markets and the economy today. We're paying attention to what's going on, and we're going to stay focused on the long term. And I would encourage you to do the same. We're here to answer your questions and be your guide as we navigate through these times. So that's our economic and market updates. With that, I'm going to turn things over to Dominic to discuss the two companies that we made initial purchases in during this quarter. Dominic?
Thanks, Justin. We've made a few new purchases in 2022 that I wanted to discuss. At the end of January, we made our first purchase of Donnelly Financial, ticker DFIN, and have continued to purchase it throughout the year. Donnelly is a financial service provider that we believe is currently misunderstood by the market. The business has historically been associated with a physical print business, where they would be the ones to send you information such as statements, mutual fund prospectus, and other regulatory filings. Donnelly still does these services, but is a much smaller portion of the business. They now have new business lines that are much more profitable and have better customer retention rates. These services relate to regulatory documents needed to take a company public and assist clients with ongoing regulatory filing requirements to the SEC and other governing bodies. If you were to look at Donnelly on the surface, it looks like a pretty boring and slow-growing company. However, when you look under the hood and see the ongoing transformation, it's a far more exciting company. As we've talked about in the past, special purpose acquisition companies, or SPACs, became a short phenomenon, resulting in hundreds of new publicly listed companies. Donnelly benefited from this SPAC craze, given all the regulatory documents needed to take a company public. This resulted in Donnelly reporting record earnings and revenue in 2021. While the company benefited on the way up, these great times didn't last forever. And now Donnelly is doing less of this business as the SPAC market has cooled off considerably. Our view is the market is overestimating the benefit Donnelly received from the SPAC market and is giving them a low valuation because the revenues generated in 2021 associated with these SPACs will decline. We think the market is missing the bigger point, that Donnelly has several other growing and profitable businesses that will offset this headwind. The company has almost no debt, and the management team believes they will generate around $500 million in free cash flow over the next 5 years, and the best part is they've historically been conservative. The company is currently valued around $900 million, which means over the next 5 years, they could generate anywhere from half to maybe 3/4 of its value. Management is incentivized properly such that they are compensated for growing this higher margin and recurring business that we like. You can read our full write-up on Seeking Alpha or reach out to us and we would be happy to send it to you. The next position I wanted to discuss is GreenFirst Forest Products, ticker ICLTF. GreenFirst is a top 10 lumber producer in Eastern Canada. The company operates 7 mills, 5 of which are located in Ontario and 2 in Quebec. This investment is a bit different compared to a traditional one we make. GreenFirst only has 2 quarters of operating history as the company acquired these mills in the past year, and prior to this, it was a cash shell company with no operating assets. I recently had the opportunity to travel to Toronto to meet with GreenFirst CEO Rick Doman, CFO Alfred Colas, President Michelle Lessard, and board member Mike Mitchell. I spent close to 4 hours with this team and was able to learn how the management company thinks, opportunities they have, and some history about the lumber industry. The insights provided from these conversations have given us added confidence in the people running the company and in the assets we own. One thing that stuck out was how similar the management team and I thought about the future capital allocation decisions and long-term operational goals of the mill. Rick Doman explained how they are improving the cost structure of mills by using a currently idled mill for parts and moving these parts to other mills that are up and running, improving the efficiency and lowering costs of these mills. If the company had to purchase these new parts, it would cost tens of millions of dollars and take several months to years to deliver. GreenFirst also has some hidden assets, including 114 acres of land in Ontario and 203,000 acres of timberland in Kapuskasing, Ontario. These assets do not generate any revenues for the company, and we believe these assets will be sold within the year. This will allow the company to pay down all of its debt, which currently has an interest rate of 10%, which is incredibly high given the current rate environment. These assets are difficult for the public to value, as they are, 1, in Canada, and 2, difficult to find comps for. While lumber prices have fallen since we made our investment, GreenFirst will remain very profitable. As Justin showed in a previous slide, the U.S. has significantly underbuilt single-family homes post the Great Financial Crisis. This investment builds on that supply problem, and demand for lumber should remain robust as the single-family housing supply-demand imbalance is corrected. GreenFirst exports over half of their lumber production to the U.S., allowing them to benefit from the current supply shortfall. The lumber industry continues to consolidate as larger producers acquire smaller ones. I believe this will continue to occur making GreenFirst a potential acquisition target in the future. Whether the company remains public or gets acquired, I believe we have the right assets and a great management team to make this a successful investment. If you would like to learn more information on the company, we would be happy to send you a write-up on it. With that, I will turn the call back to Carly.
All right, and with that, we're going to move on to the question and answer portion of the call. I believe we do have a question that was sent in ahead of time. So Peter, do you want to list that question out and your answer?
Sure. We received a question regarding the announcement last week of Seritage liquidating the real estate business and how we felt about that. In looking through the proxy materials, a significant amount of the stock is owned by Eddie Lampert, who had a number of legacy Sears assets. While we believe the assets to have tremendous value, we were concerned of the potential conflict of interest of him acquiring some of those assets. And also there's been significant management change in recent years. So yesterday we decided to sell that position, and we feel that there's better opportunities in other companies that we're more intimate with and lack the conflict of interest that we potentially see on the surface.
All right. Thanks, Peter. I don't think that we have any other questions at this time. So there is a question box that you should be able to see that you can type a question into and submit it to us. So I'll put us on mute for a couple minutes just to wait for some questions to come in, and I'll be back with you shortly. All right, we didn't receive any questions, so I think this is, oh, never mind, one just popped up. Hold on.
So the question is, with homeowners locking into such low mortgage rates, what are your thoughts on people living in their homes longer than they used to and not turning over their home? Will that create other problems? So that's a very good question, and I definitely think anybody who bought a home in the last 2 years and locked in a rate under 3% for 30 years is probably looking at the situation right now saying, I'm staying put. And there was a ton of refinances, and I think absolutely there's going to be additional lack of supply because there's millions and millions of people sitting on 30-year mortgages at these incredibly low rates. And with inflation rising, that means they're paying back those mortgages with inflated dollars, and there's not really a whole lot of incentive to move. So it's the question that you've asked is in further support of our thesis, which is there's going to be a huge housing shortage for the next 10 years. There's a lot of pressure on the supply side, and growing pressure on the demand side. And so I think, home building and even the rental market, those are going to be very strong markets. It's not going to be an easy time for people at lower income levels because housing prices are on the rise because of this imbalance between supply and demand. It's economics 101. So yeah, I do think that will create other problems that are consistent with the remarks that we've made. Just because of the low mortgage rates that were locked in over the last 2 years, whether those were new home purchases or refinances. So good question. The next question that came in, I need to expand this. Hersha Hospitality Trust notes there is a high likelihood they will be selling additional shares. So can we comment on that situation?
Sure. Actually, with the COVID-19 situation, and hotels closing down for an extended period of time certainly put lots of pressure on those. Hersha Hospitality has sold a number of hotels at what they feel are reasonable prices to help with that. The management team owns a significant amount of stock as well. And so they've done everything they can to preclude them from having to issue additional shares. But naturally, the additional shares will be dilutive to stock and certainly harmful to the overall value of those companies. But if that's what it's going to take for survival, we're in favor of them doing that. In their recent press releases, they announced that they had felt they weren't going to sell in additional hotels, but additional equity will hurt both the management team and the shareholders to some extent. But the price of the security is still way down at pre-COVID levels. So, anything you want to add?
No, thank you. One other question has come in. Will Fannie Mae lose money in a rising rate environment?
No, they won't. They'll still be an incredibly profitable business. And with Fannie Mae, what we're really looking for is for them to build capital. So the amount of equity they have to raise to exit conservatorship is less. And if you have to raise less equity, it'll make it easier to raise in the public markets. Raising $30 billion, $40 billion is a lot easier than raising $100 billion. So actually, when rates rise, the amount of originations they'll do is likely going to decline, but actually they'll be able to build even more reserves, resulting in less capital that they need to raise in the future. So rising rates is actually going to be neutral to maybe beneficial for them. On that side, might hurt on their origination side, but they'll still be an incredible business.
Sure. Maybe we'll add to that is that the strategic plan for the Federal Housing Administration came out several months ago, and they continue to focus on building the capital for Fannie Mae and their sister company Freddie Mac as well. So it continues to be an incredibly undervalued situation. This is going to be resolved either on a political basis or in the courts as well. And so it seems to be moving along, but it's at a snail's pace.
All right, and I think that does it for questions on this call. So we're going to end this call for today. As a reminder, you can send in questions you'd like answered by your team via email prior to these calls. And you can email any member of our team with your questions, and we'll be sure to address them on the calls in the future. Thank you for tuning into our commentary on the market and your investments, and this will be available for replay within 24 hours on our website.